Hello, good afternoon. Thank you for joining us today as we talk about some year-end charitable giving considerations. I'm Brandy Ward, an Associate Wealth Manager here at Windward, and today I'll be joined by Daryl Tierney, Certified Public Accountant and Certified Financial Planner, along with Matt Belomo, a Certified Public Accountant. As Matt and Daryl are presenting today, please drop any questions you have as they come up. You can see on your screen what the question box will look like. Just type your question in the box and hit send. With that, I'll turn it over to Daryl and Matt.
Good afternoon, everybody.
Yep, good afternoon, and thanks for joining us today. We have a thrilling charitable contribution conversation to have with you all today. I'm Matt Belomo, and I am going to start with what is new in 2020 as it relates to charitable contributions. The first item, both of which came to us from the CARES Act, passed in March of 2020. The first one being $300 deduction for those taxpayers who do not itemize on their tax return. They're entitled to a $300 deduction for charitable contributions above the line in computing their adjusted gross income for the current year. And for those who are very charitably inclined, it should be noted that the 60% AGI limitation for cash contributions has been increased to 100% of adjusted gross income. In other words, you could give up to 100% of your adjusted gross income if you gave only cash. Not likely, but nonetheless, it is a change in 2020. With that, I wanted to kind of set the stage also for what we are going to discuss today. And I'm going to mention and give an example about bunching of charitable contributions. With the next slide, we're going to talk about maximizing the benefit you receive for your charitable contributions. And part of that is optimizing the itemized versus the standard deduction in a given year. In a given year, a married filing joint taxpayers have a deduction available to them, standard deduction available to them of $24,800. And in my example here, which Brandy did a great job of pointing out that we need to find the right balance here, is a taxpayer who has $10,000 of taxes, that is property taxes, income taxes, and real estate taxes, which have a $10,000 cap now. They have $8,000 of mortgage interest and $5,000 of charitable contributions in the given year. That totals $23,000, which is less than the standard deduction. Therefore, in this example, the taxpayers would get the benefit of the higher standard deduction, $24,800, which in this example, the $5,000 of charitable contributions was not utilized at all. And so in the next slide, we're going to show you if we were to bunch, say, 3 years worth of charitable contributions into the current year, how that impacts your taxes. So we'll see the example of $23,000 from the prior year, or sorry, the prior example. We're going to add $10,000 at $5,000 a year, which is 2 years. Total itemized then would be $33,000, which exceeds the standard deduction by $8,200. The tax savings on that would be approximately $2,300. So if cash flow were to allow for this, you'd benefit $2,300 in the current year while still getting the full benefit of the standard deduction in years 2 and 3. Daryl, anything to add while we're talking about this before I move forward?
You know, really two things jump out at me, Matt. So number one, it looks like there's about 3 things to think about. You've got state and local taxes, mortgage interest, and charitable contributions. And for the average individual in today's world, that's most of the deductions. I mean, we get medical in there, but there's just not a lot in the way where we used to get employee business expenses and miscellaneous, all that's gone. So, and it's so important to know where you are relative to the standard deduction. That's one. And then the other comment that might surprise some people. So the standard deduction for a single individual is basically half of what it is for married couples, but the cap on state and local taxes is the same. So they have that same $10,000 cap. So it's very possible a married couple may have a bigger gap to close to bunch to get over that standard deduction.
Yeah.
So, but just important to know where you are relative to the standard deduction.
Yeah, that's a good point. And this bunching is going to come in when Daryl talks in the future here about the gift of appreciated securities and donor advised funds. So the bunching is really important as we go forward. Next, we're going to talk about charitable distributions from your IRA. They are called qualified charitable distributions, QCDs for short. And I wanted to touch base briefly on what they are, what the requirements are, and then we'll talk about the advantages. The requirements are they're only available currently for IRAs, which include SEP IRAs and inherited IRAs. There is some discussion in Congress about allowing for a distribution from a 401k, but that is not currently available. So just stay tuned on that. A QCD must be made after you are 70 and a half, which is a little different than the RMD, which needs to be made in the year in which you turn 70 and a half. In order for you to make a QCD, and I cannot stress this enough, you must have already obtained 70 and a half years. And this is very important because I've had 2 instances where the IRS has inquired as to when the QCDs were made. In both cases, they were made after 70 and a half, but this is a very bright line test, and it's important to make sure that we pass this test. And the distributions must go directly from the IRA account to the qualified charity, 501c3 charity. This can be done in typically 2 ways. One, paperwork is submitted to the custodian that makes a distribution, saying I want to distribute $500 to my church or synagogue. Or for other taxpayers, we set up a separate IRA account to fund their current year's distributions to charity. So for instance, if a client says, hey, I'm going to distribute $5,000 to charity, give me a checkbook and I'll make those distributions, which is great. But keep in mind, if to the extent those distributions are not made, they will be taxable. And I also want to mention here, it's important to keep your receipts and the documentation so that we properly tax the IRA distributions in the current year. And we'll talk a little bit about that here in a minute. A couple items to note that are questions we get regularly. And for those folks who do not have to begin taking RMDs until they reach 72 years old, that happened under the Secure Act, which passed in December last year, you can still make a qualified charitable distribution from your IRA if you are already 70 and a half. So in other words, they didn't make the QCD 72 for those folks. It remains 70 and a half. So that's important to note because at that point, you're already receiving Social Security. Income is probably a little higher. It does not, for 2020, the CARES Act suspended required minimum distributions for the 2020 tax year. For those people who are already required to take distribution, this does not preclude you from making a QCD in the current year to a charity of your choice? We get these two questions often, and so we wanted to make sure that we pointed those out to each of you in consideration of a QCD. Daryl, anything to add here?
Matt, the only thing I'd really add, just kind of a comment. What we do maybe as this is strictly from a practical standpoint, not part of the tax code. As Matt mentioned, we frequently will set up a separate IRA to handle these QCDs. That's not a requirement, mostly because, and we call those, we may call those a checkbook IRA. We get a client check writing. The reason we like to do that is because in today's world of identity theft, it's not a great concept to have checks floating around with a signature and an address and all that on a big IRA account. And so we can kind of limit this. So versus having a, if a client's got a $500,000 IRA account, we've got checks floating around, we're much more comfortable. Let's just set up a smaller IRA and do our disbursements from there. So that's just kind of a practical way we go about it, but it seems to work well.
Yeah, and the practical thing there too also is the detail of those distributions provide great detail for determining the taxable amount. So it helps delineate the different types of distributions. That's a great point.
That's right.
On our next slide, we're going to talk about a few advantages to doing a QCD. The first one being QCDs reduce your income. And again, to go back to our previous example, if you have, say, a $40,000 required minimum distribution and you give $5,000 to charity, your taxable IRA distribution is $35,000, even though $40,000 came out, the $5,000 being the qualified charitable distribution. So that is very helpful in managing our income. The neat thing too about a QCD is that an IRA gives rise to ordinary income. And when you make a QCD, you receive the maximum benefit of the tax rates in which you're in. An example would be that $5,000, if you're in the 24% tax bracket, you would get 24% nominal rate, not the effective rate. So that's also important to note. And kind of back to what we were talking about earlier with the standard deduction and the itemized deductions, taking a QCD does not impact the standard deduction. So you still get full benefit for your standard deduction. So if you're over 70.5 and you wouldn't otherwise itemize, you still get all the standard deduction and the reduction in income of the QCD. So you kind of get a double benefit there, which is a really neat thing. A couple other things to keep in mind. Because your income is lower, it may reduce the taxability of your Social Security, especially for folks who have lower adjusted gross incomes. And it may reduce your Medicare surcharge, which, as we all know, can get pretty expensive. And so these are just a handful of the things that we keep in mind as we plan for optimizing the charitable strategies. Daryl, anything else that I maybe missed here or comments you'd like to add?
Well, the only thing I would say, Matt, it's a little bit counterintuitive. This strategy is a benefit, can be a benefit whether you take a standard deduction or you itemize. And I think it's a little more obvious if you take a standard deduction that you're getting money out of your IRA tax-free. But interestingly, if you itemize deductions, let's say you took $1,000 out of your IRA, and then just, basically the way we always did it, you make $1,000 contribution. You say, well, the effect on taxable income is, those two wash out, and so you're not paying tax on the IRA distribution. And Matt makes a great point in that when you do the QCD, it reduces the adjusted gross income, which is that number that is before your itemized deductions. And man, that ends up being kind of a magic number in the tax world because so many things are tied to it. So as he mentioned, taxability of Social Security, If you're in a Medicare surcharge situation, it can affect that. Most people are familiar with medical deductions. The lower your income, the more medical deductions you may well get. There is a Medicare surcharge on investment income for people that have a high enough adjusted gross income. So, you have to go through the mechanics of the calculation, but it's not only the effect on taxable income directly, but affecting your adjusted gross income may put you in a better situation.
That's correct. Good points.
Yeah. So probably a good lead into, or I guess maybe in summary on this, what we've been talking about it, at the outset, we mentioned bunching deductions. Really, the bunching deductions isn't necessarily applicable to the QCD IRA, but that's really available for people that are 70 and a half, as Matt mentioned. So what we want to talk about now is making gifts of appreciated securities. So on the next slide, we'll just kind of talk about some of the advantages. But really, what we're talking about on gifts of appreciated securities, what we're talking about is, let's say you had a $10,000 investment. You paid $1 for that, so you've had substantial appreciation. And if we compare that to $10,000 that you might have in a bank account, if you have $10,000 in your checking account, you can write a check for $10,000. You get the full benefit. But unfortunately, with a security like that where it's appreciated, the only way you're going to be able to spend that is you're going to have to sell the investment. And if you've held that investment over 12 months, it's going to get long-term capital gains treatment, which means it may well be taxed at a lower rate than you're in. In fact, it's possible that you don't pay tax on that. So that's one of the things you need to know, because there's actually a 0 capital gains rate, as well as a 15% and 20% capital gains rate. But for example, if you're in a 20% capital gains rate, to spend that, if you're going to try to spend that $10,000, you're going to liquidate it. You're going to pay $2,000 in capital gains tax, leaving you $8,000 to spend. So one of the beauties of making a gift of appreciated securities is it gives you a way to spend that money that is not taxable, because you can actually contribute, make a charitable contribution of an appreciated security, and you don't pay tax on the capital gain, and you actually get a deduction for that full fair market value. So in my case, you get a deduction for the full $10,000. So great way to use the full fair market value and not pay the tax. From a practical standpoint, what we find, I mean, literally what you do is contact the charity and say, I'd like to make a gift of an appreciated security. They are very, very used to this, most of them. And most of them actually will have a brokerage account that is a part of the charity, that you can make a transfer of your investment directly to them. The idea is they are a not-for-profit, so they can sell the $10,000 security. They pay no income tax, and they can use the full amount of the proceeds. So it's a great technique. You do have to make sure you've held the security for 12 months so that you get long-term capital gains treatment. Those are the ones that are eligible. And frankly, the best candidates are the ones that have appreciated the most, because you may have, obviously different investments are going to perform differently. One of the things where we find this really attractive is frequently publicly traded employers. They part of their mission is to kind of tie the employees' riches to their own, and so to get everybody's interests aligned. And so frequently there are stock options that may be available to employees. They may have employee stock purchase plans where they can buy their employer stock at a discount. And certainly employees like to just, they're familiar with the company. They may want to go out in the open market and buy their company stock. When we're working with them from a wealth management standpoint, sometimes that presents risk that concern us, so that we feel like if somebody's got a large enough position in an employer security, they've got a lot of their livelihood. They may have their retirement, their current salary, as well as significant amount of assets tied up in the employer, where our job is to say, we feel like you need to be diversified. Well, this frequently gives us a tremendous way to diversify, where we can say, hey, look, if you're charitably inclined, a good way to help diversify, rather than making cash contributions, perhaps make gifts of this concentrated position in a security, gift this company stock, and you not only avoid the capital gain, get the tax deduction, but it helps you diversify. So those are always really good, attractive ways to do things. And then another, often when we see gifts of appreciated securities, they may be made to a single charity. So it may be a situation where a charity is having a large capital campaign, and so a taxpayer or a client will give a single security to help fund that. In a second here, we're going to talk about donor advised funds, which may be a way to get the same benefit of donating these appreciated securities, but then also spread it out amongst many charities, which is a good way to go. Might be easier than splitting up a security into multiple pieces and giving away to multiple charities. So, Matt, anything to add to that?
I would add two things. One being, in the concentrated position, when you are going to identify the stock, make sure you tell your broker that you want to sell the lowest basis shares, and then make sure that that's updated in the basis schedule, so that we, in planning to mitigate some of the concentrated positions, we are aware of that.
And you said sell, you meant contribute.
I'm sorry, contribute. Yes, sir.
Yeah.
The ones you're going to give to the charity.
That's right. And did you have anything else?
No, just make sure the basis schedule is updated as well.
Great.
I mean, if you have stock over 5 years at different times, different stock is appreciated more.
So next, let's talk a little bit about donor advised funds. So what is a donor advised fund? We've mentioned that. On the next slide, you'll see we have typically what happens is somebody is making a contribution directly to the end charity. And Brandy, can you advance us to the next slide, please? So basically what happens is we make as I said, you make your contribution directly to the end charity, whatever that may be. What the donor advised fund is, it literally is a not-for-profit, might be a custodian like Fidelity or Charles Schwab or Vanguard. They establish these not-for-profits. Here in Kansas City, we're fortunate to have the Greater Kansas City Community Foundation. We're very familiar with them. We've got many clients that have worked with them. They happen to be, I think, maybe the second largest donor advised fund in the country. But what we do is, in between you and your ultimate gift to charity, you have this donor advised fund. You make your charitable contribution to the donor advised fund. That is where you get your tax deduction. So whether it's cash or an appreciated security, you transfer legal ownership to this donor advised fund, you get the tax deduction. Then the donor advised fund establishes a separate account in your name, and allows you to advise them on where they want the money to, where you want the money to go. So you can let them know, I'd like to send X number of dollars to this charity, X number of dollars to this charity, and whatever. The beauty is the tax deduction is when you move the money to the donor advised fund. It is then legally theirs, and when there is no tax deduction when the money moves from them to the charity, so that you can control the timing. You can make a contribution to donor advised fund when you need the tax deduction, and let's an example might be you have your local charity has a big fundraising campaign for a capital contribution. You want to let's say you're in a situation where you want a large tax deduction. You can trigger that when you need to by the contribution to the donor advised fund, but you can dribble it out to the charity however you want to. In fact, there is no requirement. You can actually wait a number of years if you'd like to make this, to let this money to appreciate. So I think the important point to kind of emphasize is the money is legally, once you've made the transfer, it is legally the donor advised funds, their asset. They're going to take advice from you, but they don't have to follow your advice. Now, what I would say is 99.9% of the time, they will take your direction when you say give to this charity. Probably the time they wouldn't do it is if it was not a 501c3 registered charity. So, if you say, hey, we've identified a family we want to give money to, that is not a 501c3 charity. A charitable deduction is not allowed for them. So they won't do that out of the fund. But otherwise, as long as it's a, your normal charity, that you're gonna get the tax deduction. So let's just talk about some of the kind of characteristics and advantages on the next slide of donor advised fund. So as I mentioned, you're going to establish a separate investment account. So the beauty of that is if you're looking at this as a long-term investment, you can make and get a charitable contribution now, but still invest the money for the long term. So that, it could be for a donation that ultimately comes out to the charity, say 5 or 10 years from now. We'd mentioned earlier that it's a great tool. You can certainly contribute cash to these, but it's a great tool for appreciated securities, because the contribution of appreciated securities and donor advised fund, where we're typically using these is back to Matt's example at the beginning, where we're trying to take advantage of this bunching. And so we frequently see appreciated securities, and again, the donor advised funds are not for profit. You contribute your $10,000 in there, and the donor advised fund can actually sell.
Hey, Daryl, we lost your audio there for a second.
Let me go back for a second. Okay.
I got you back now.
So I'm not sure where I got cut off. That's probably a good thing. Cut me off. Was I going too long? Did Matt do that? No, I was just gonna say the contribution. These are well suited for the contribution of securities, and we typically are using these donor advised funds to take advantage of bunching. And again, like my $10,000 example, you transfer $10,000 into the donor advised fund. They are a not-for-profit. They can sell the securities, and so you're going to get the benefit of the full amount. So that in itself is really good. Another place where this gets used frequently, it really gives you control over the timing of your tax deduction. So we like to use these when somebody has a high income year. So if you have had perhaps a sale of a business, or it's a big bonus year or whatever. If there's some kind of an event that's a high income year, you can use these in effect almost to prepay your charitable contributions, but the charities themselves don't get the ultimate money for many, many years, or however you direct them. So it's really, really effective, for that kind of management of your tax liability. A practical, just kind of maybe some practical things to think about. As I mentioned, we work pretty closely with the Greater Kansas City Community Foundation, but there are lots of these. So you could go to Vanguard, Fidelity, as I mentioned. Many custodians have these. What I would look at from a practical standpoint in doing this is their fees typically are a percentage of assets that are in the plan. They charge, it might be a 1% charge or whatever their fee schedule is. Some of these may allow an advisor to manage the fund. So I know they do, for example, at the Greater Kansas City Community Foundation. For most of the Windward clients, we're actually continuing to manage the money with input from both the client and the donor advised fund. So we work together, but I know they have a program where the foundation itself can manage the funds, or you can use an advisor to manage the funds. So that fits into some people's needs. That's something to ask about. The other thing I think that's an important thing to kind of get clear is some of these donor advised funds have minimums on both ends. So a minimum on how much can be contributed. They may say, hey, look, we want a minimum of a $25,000 contribution. Greater Kansas City Community Foundation does not have a minimum on how much can go in on the front end. Some of these funds have minimums on the back end. So how much can go out of the fund for the in charity? They may say it's a minimum of $1,000. Again, Greater Kansas City Community Foundation doesn't have a minimum on that end. So that's all part of the weighing process as you're kind of evaluating which one of these may be useful. And before I ask Matt if he's got anything to add, the only other thing that I would say is there are other vehicles in the tax world that people use to do this same thing. So you may see or have heard of private foundations. So a private foundation is very similar to a donor advised fund. The difference is a private foundation is going to be something that is more expensive to administrate. It may be more appropriate for substantially larger gifts, because a private foundation is going to have legal work to establish it. There's an ongoing board of directors that may be ongoing legal fees. It files an annual tax return, and a private foundation like that actually has to distribute a percentage of their assets to charity annually, where under present tax law, that's not required of a donor advised fund. And there really is no, other than the fees you pay to the donor advised fund, it's much more of a cost effective vehicle for smaller contributions, for a smaller situation. So Matt, anything I missed on that, or anything you want to add?
No, I'll add a few things along the lines of the private foundations. Oftentimes somebody will have a charitable remainder trust perhaps pitched to them. Again, very similar animal. The donor advised fund checks a lot of boxes and is administratively much easier than many of the other vehicles available to taxpayers. One of the things that we implied when we talked about the donor advised fund, especially as it relates to these concentrated stock positions, is you can give them and you can immediately diversify those holdings to then fund the future benefits to the charities. So in other words, your future gifts aren't also predicated on a single stock. So that's kind of a benefit that we implied, but I wanted to make sure we got that out there. Back to me talking about the QCDs, note that the QCD cannot be used to fund a donor advised fund. If you want to use cash that's in an IRA, you'd have to take it out and then contribute cash, take an itemized deduction, which may not help from a tax perspective that much.
You won't get that lowering of the adjusted.
Go ahead. I'm sorry, Daryl.
No, I was going to say you don't get that lowering of the adjusted gross income in that
Correct.
case. Yeah.
Correct. And so, you know, we've got to be thoughtful about how we utilize the different tools that are available to us, different techniques. But just a few little housekeeping things. The neat thing about working with a donor advised fund is the charities themselves will kind of vet the contribution. So they'll make sure that you give gifts to a 501c3. And so, for instance, you don't accidentally give a gift to a political campaign, which are non-deductible. Also, clients will buy a table at an event, the snowball, for instance, the hardball, whatever it might be, and a portion of that is non-deductible. And what the community foundation will do is they will cut the charitable percentage of the check to the charity, give it to you, and then you will deliver to the charity both the non-deductible share, which you will pay out of your pocket, as well as the charitable piece. So again, it keeps that nice and clean. And the last thing I'll mention is, and this is one of the really neat things about the donor advised fund that is similar to a private foundation, is generally speaking, those are set up to help fulfill the philanthropic goals of a family. So what it does is it allows for some multi-generational planning on the charitable side and gets the younger generations involved. And one little short story is a client that I'm aware of will say to his and her grandchildren, we'll give $100 to a charity of your choice, but we want you to do a little research as to what happens in that charity. And so it helps really drive home what the family's trying to do long-term in the community in their choices of charities. So just a few little housekeeping things that I think are important to note.
Yeah, and you can literally name a successor advisor, and the successors can name successors. So these things can be in the families for a long time. People may adjust their estate plans so that they can, make contributions to further fund the donor advised fund after they pass. So it's a great situation. I mentioned legally, once that money is in the donor advised fund, it is it's legally not your money anymore. But from a practical standpoint, so for example, we custody our clients' assets at TD Ameritrade. Literally, we would set up a TD Ameritrade account in the name of the Greater Kansas City Community Foundation, and our client, the donor, still has the ability to pull that account up with their other accounts and look at it and keep their eye on it. And, so it just, it's legally, it's not your money anymore. But again, it's just one more way of feeling a part of what you're doing and keeping an eye on things. And as Matt said, great point about using it as kind of a big family teaching tool. And that's a great use of it. So with that, Matt, unless you have anything else, we can open it up to get Brandy back here and open it up to questions.
Let's see what questions we might have here.
All right, so before I look at the questions, I'll just remind you guys, if you have any, you can drop those in the question box. On your screen, there might be a little panel to the right, and you might have to extend that to see the question box, but that's where you do it. So I will start with our first question. Get it pulled up here. Do I need to retain my receipts for contributions from my QCD?
The answer is yes, you do. Typically, if you are writing checks, you'll keep a copy of the check and match it with the receipt. Or if you've instructed the custodian to send a check, that paperwork that instructed them, and you keep that with the receipt, because that helps us determine the taxable portion of the IRA in the given year.
And really in a year, if you do this kind of mid-year and you've got some, let's say you're itemizing and you may have some checks you've written the old-fashioned way and made contribution, and other that came out of the QCD. Really important your tax preparer knows which is which, because getting the tax benefit is predicated on them treating that correctly on the tax return. And the checks coming out are going to look like a taxable distribution if the preparer doesn't get that treated correctly. So it's really important to differentiate that.
Yep, that's a good question.
Good question. Okay. Our next question is it a good strategy to gift appreciated stocks to a charity if that person does not have a donor advised fund?
For sure.
I think, yes. I think really where we see the gifting of appreciated securities, it's useful really to hit that bunching threshold. That's where that's really useful. But even if you're over the threshold and you're itemizing deductions and you're far over, it's a way to spend that money without incurring taxes. So, if you have X number of dollars to run down to the grocery store, do that out of your checking account rather than sell the stock to fund that. If you're going to make a contribution, use the appreciated securities. So yes, I think it is advantageous.
Yeah, that double benefit of the full fair market value and the reduction in the capital gains tax is a double benefit that's really nice. So absolutely there's merit in that. And generally speaking, those are for larger capital campaign type contributions.
Good. Okay, our last question we have time for today is this. If I'm 75 with a large IRA, is it better to contribute from a qualified charitable distribution or a donor advised fund?
That's a good question.
Yeah.
The general rule would be QCD. However, you could have a large monetization event and accordingly a lot of income. And in that case, the itemized deduction might be useful. So again, general rule QCD because it comes right off the top. But there is absolutely merit in a donor advised fund, or perhaps even a combination of the two, depending on the particular situation, fact pattern.
Right, and it could, so one of the things that could sway our advice on that, if we felt like you were not diversified because of that position, that may affect where we think you get the most benefit. So it's not, we don't want to let the tax tail wag the dog. It may not be just tax driven.
Yep, good point.
Yeah.
All right, well, I think that covers it for today. The big picture here is if you are charitably inclined, we want to help you meet your philanthropic goals in a tax efficient way. This webinar has been recorded and it will be available on our website sometime in the next few weeks. If you've enjoyed it, feel free to share it with your family and friends once it's out. We'd really appreciate it. We plan to hold more webinars in the future, so if there's a specific topic you'd like us to cover, let us know. You can pass your suggestions along to me. My email is on your screen, and we may cover your topic in the future. If you have any questions about anything you heard today or would like to hear more about Windward, please reach out. We'd love to hear from you. So have a good afternoon and a good holiday season. Thanks.
Thank you.
Thank you.